now I want to take you through the direct financing piece. Okay, so we'll at least cover the concepts completely. So what is direct financing piece? Now see what is happening. If you look at it, I'm having a lease where neither the S nor T nor O nor P nor S is being met. The moment none of this is met, I go to the lessee's book and I call it operating lease. I go to the lessor's book, lessor says, wait, tell me if I take the PV of guaranteed value by the third party, then will the P criteria be met? So third party guaranteed residual value. Is the P criteria met? And the answer is yes. You say, okay, yes. And we say, do you think the third party is going to pay you? And you say, yes. And we say, okay, I'm going to not treat it like an operating lease. I'm going to treat it like a direct financing lease. But understand, this is very, very rare, guys, because it's a very rare situation. It spills down to the third party. So what is going to happen? You go to the company. The lessee will not gain control of the underlying asset. In other words, the lessee will not be the owner of the asset. For the lessee, it becomes an operating lease. The lessor will de-recognize the asset. That means there will be a receivable in the books of the lessor, just like we did it for the sale. There will be the asset which will go away in the lessor's book, but that gain on sale that we recognized, that we will not recognize anymore. Okay? See, the lessor will de-recognize the asset. That means the asset will no longer be on the lessor's book. He will recognize. So net received investment in the lease is actually equal to your lease receivable. In my example, in the earlier case, what we did was lease, that is net investment in lease. So what is this net investment? It is the lease that is receivable plus that residual asset that a third party is guaranteeing. Please understand, we don't recognize any gain. We're simply going to defer all gains. But if there are any losses, I will recognize it immediately. Even if there are any direct costs, I am not going to allow you to expense it. I'm going to capitalize it as a leased asset and then amortize it over the tenure of the lease term. And I am going to let you have the interest and I'm going to let you use the effective interest method. Now, this is a very toned down version of the question, guys, just to give you an idea. In real life, the questions are not that simple. And I'll tell you how complicated can it become. I'll just take you through there, mentally, if you can understand it. Even if you don't fret a lot. Practically, this has very little usage. Okay. So I'm just doing this question together. See if this makes sense. A lessor leases a truck to a lessee for 4 years at 5,000 per year. There's an initial direct cost of 450 and the rate which is implicit in the lease is 6%. On the date when the lease is commencing, the carrying and the fair value of the asset is 23,767. The lessor expects that the truck will be worth 8,700 when the lease ends. Now, ideally, this is a very toned down version and I've already told you that it's a direct financing lease. If they don't tell you, then ideally this will be the third party guarantee of residual value. Just remember that, okay? And they've given you that the annuity of $1 for 4 years is this much, and the annuity for the annuity for 4 years is this much. Can you quickly tell me what is a PV of lease payments? Quickly, guys. What is a PV of lease payments? Just calculate it and tell me. What is a PV of lease payments? What is the PV of lease payments, guys? Just calculate. Now, by now, we should be able to calculate it, right? Just take the 4 rental payments, multiply it by the annuity factor, and take this 8,700, which is the guaranteed value at the end of the lease term, multiply it by the annuity of $1 at 6%. What's the answer? We'll talk about 450. Just leave it aside, Vishnu. Just leave it aside. Right now, just tell me what is the PV of the lease payments.
$24,217.
So PV of lease payments is actually 24,217. How do you get this? You take what was the monthly lease? 5,000.
5,000
into 3.4652. This will be the annuity. and the ending is 8700 multiplied by 79207. So what you get is 24217. So this is what? From the lessor's books only, right? We will not see the lessee's book. So what is he going to get? The lease receivable is going to be at 24217. Is that clear? The truck will go away at what figure, right? Truck will go away at what figure? The value of the truck, which is the carrying value, 23,767. And there will be a cash outflow to the tune of 450, which will be on the indirect cost. One second, just let me do this. Is this clear? 23. Do you realize what we're doing? We're capitalizing the indirect costs. We are not expensing it. There is no element of the indirect cost which is going in the P&L and hitting it in the P&L. This is not what we do when it is a normal sale type lease. We expense these costs if there is a gain or a loss which is coming. Okay, ideally you will just book it in the P&L and we will credit it to cash. But in case of direct financing type lease, we will not let you put anything in the P&L at the beginning. And there will be no gain or a loss that will be booked. Everything will be just the asset coming and the asset going. Is this clear? And the first time when you take, Vishnu, is this clear? And the first time when you take the interest element, you will take the interest element the normal way. You find out the rate implicit in the lease, it is 6%. What was the opening value of the lease liability? 23,767. Is that clear? Okay. So what I will do, I will take interest. This is the receivable, guys. Okay, I'm talking from the lessor's perspective. So I'm going to get cash of how much? 5,000. Some amount of this cash will be interest income, and the balance will be this lease receivable, which will go down. How much will this be? We'll take the beginning liability of how much? 24,217. This is the asset, right? So we'll take 24,217 multiplied by 0.06%. How much is it coming, guys? $1,453. So that will be my interest element, and the balance will be my lease receivable. Actually, this is not the real thing, guys. This is a very, very toned down version of the question. I'll tell you what happens in real life. Okay, if you can understand this, at least I've just taken you mentally in that area. What would happen is this, guys. In case of direct financing lease, there will be two rates. One is the rate that will be given to you in the question, and the other is the implicit rate that you will have to calculate. So you will take the PV of the rental payments, PV of the guaranteed residual value by the lessor and the third party. You will equate all of it, and you know the way we used to calculate IRR in our net present value approach, you will take that permutation combination and you will arrive at the interest rate which is implicit in the rate. So what you will do in the beginning, you will just book an asset and the liability. You take the new asset which is lease receivable, you will remove the old asset which is truck or machine or furniture or whatever else. Don't book any gain or a loss. Then you calculate the rate implicit in the lease. Then you book the interest element on the basis of that rate. And then you defer the gains, and then you know, there is a way by which those deferred gains have to be recognized in the books. But this is beyond the scope of your CPA exam. They will not ask you these questions. Okay. So what all I want you to understand is don't book the gains, book a new asset. Do not hit your P&L with indirect costs. Just book the asset, take away the truck. Only if there is a loss, I will let you book the losses. The gains will not be booked. And the normal stuff, find out the rate implicit in the lease, and the interest calculation will be on the basis of rate which is implicit in the lease. That's it. This is a little gray. I know we've not dealt with it very well because that is beyond the scope of your exam, frankly. Okay, so those of you who are with me, once you've done the questions on leases, once you reach that stage, if you ask me, I will give you one complicated question and we will just let you mentally go through that level. Okay, but right now it will be a little too much for you to digest at this point. So I'm not going to cover. If this is clear, we're going to proceed further. Is this clear?
Shraddha, I have a question here. The lease receivable
Yeah.
first entry itself balances, lease receivable to truck and to cash. It might not balance sometimes.
So what you will take the lease receipt. So you will capitalize the asset by the indirect cost. You'll take the total figure, and whatever is the fee, let's say it was actually 23,767. You will add the lease indirect cost and you will book the cash. You will not debit it to P&L. Is that clear?
No.
And you will not book the gain. Even that gain
Yeah.
element you will remove. So
Right.
cost to cost basis, you will remove the asset. You will debit the lease receivable with your indirect costs, as well as with all your direct costs, as well as the assets carrying value that you had in your books. Is that clear?
No, no, somehow I'm not clear. Like a lease, suppose if the lease receivable is more in this case, so where will the balancing figure go?
No, the balancing figure will never come. See, this is the carrying value of the asset, right?
Right, yeah.
So this is the carrying value of the asset. The lease receivable is actually the carrying value plus your indirect cost, always. And this is actually, so okay, I'll just tell you what actually, forget that you have indirect cost. Is that clear? Just
Okay.
imagine that there are no direct costs. What you will take the carrying value of the asset at 23,767, right?
Right.
The lease receivable will also be 23,767. That's it. Whatever is the value of the asset, that same value will record it as the lease receivable. You will not book any gain, you will not book any, because see, the gain or the loss is the actual delta between the PV and the value of the asset, isn't it?
Right. So
You
like
will not, yeah.
we'll figure out the PV factors and then we'll come out with the lease receivable. So it will automatically balance with the carrying value always.
No, it will not. Because if it will not, then there is a gain.
Oh, so then we'll,
Yes or no?
yeah.
You will not put that gain. You will not see if there is a delta, that means there is a gain or a loss, right?
Okay, so we'll adjust in lease receivable.
Yes, that is what I'm saying. That
Okay.
ideally, imagine if it was just cut to cut, there is no gain, there is no loss. Then this will be exactly the same. If there is a
Right.
gain, you will remove the gain. You will just book the asset, new asset at the value of the old asset, and you will defer the gain.
Right.
If there is a loss, then you will book the loss. If there is indirect cost, you will capitalize the lease receivable and you will book cash. You will not put anything in the P&L. Is this clear?
Yeah, sure. Yeah,
That is why I told you this is a very toned down version, because if you take a real good question, it will never work out like this. It will give you guaranteed unresidual value. You will have to factor that in. Then you have to calculate the delta between the selling price and the carrying value. And that amount you will have to defer as gain. You cannot book it in your book. We understood?
Yeah, got it.
So no gain, only losses to be booked. Whatever is the carrying value, that will become the lease receivable. Is that clear?
Yeah. Thank you.
So this is actually a very, very, it's a snapshot of a question just to give you for the sake of giving, ideally. But this is actually a very, very toned down. So basically, we've not calculated. We've just taken certain figures and have put it for you to make some sense. In real life, actually, the 6% is not given to you. You have to calculate it. So book the asset, take the old asset, bring the new asset at the exact same figure. Okay. If there is an indirect cost, just defer it. That means book it in the lease receivable and credit cash. Then calculate the rate implicit in the lease. On that rate, calculate your interest income. And then proportionately bring out a part of your deferred gain and book it in the P&L. But that is beyond the scope of your exam. We're not doing. Is this clear?